In the wake of the controversies surrounding naked short selling and synthetic shares, a new financial maneuver has emerged. Known as synthetic risk transfers, orchestrated by banks looking to navigate the evolving landscape of capital requirements. This marks another chapter in the ongoing saga of financial institutions reinventing their strategies. The Wall Street Journal recently shed light on this development, revealing how US banks are adopting innovative approaches to mitigate risk and comply with the new capital requirements.
Hello everyone.
Welcome to Daily Stock Update. If you are new to the channel, be sure to subscribe to the channel and turn on post notifications by hitting the bell, so you never miss any of our uploads and also enter our giveaway. But before that, alert, this is not a financial advice video. Recapping the events of the preceding year, tighter regulations have compelled banks to reassess their exposure and portfolio ratios, prompting them to offload riskier assets to other entities. Enter synthetic risk transfers, a mechanism whereby major Wall Street banks like JP Morgan Chase, Morgan Stanley, and US Bank are selling intricate debt instruments to hedge funds and private equity funds. The objective? To circumvent regulatory capital changes that could impede lending activities. The crux of this strategy lies in the creation of synthetic risk transfers, a costly yet pragmatic alternative for banks compared to shouldering full capital charges on the underlying assets. While these transfers may strain the bank's finances, they present an attractive proposition for investors, offering potential returns of around 15%. US banks had largely stayed on the sidelines of this market until the autumn, strategically observing whether the Federal Reserve would adjust its stance. They were cautious, waiting until the 11th hour to gauge whether the Fed would refrain from imposing heightened capital requirements or demanding specific audits. Additionally, new SEC regulations targeting banking institutions may also extend to non-bank entities. The hedge funds, however, face the brunt of the risk in this scenario. While banks play it safe and assume minimal risk in most of these synthetic risk transfers, investors, particularly hedge funds, are the ones exposed to potential losses. The mechanism involves investors purchasing credit-linked notes issued by the bank, collecting interest on these notes, and effectively shouldering losses if borrowers default on up to 10% of the pooled loans. Delving into the numbers, around 10% of the bank's loan portfolios are encapsulated in these credit-linked notes and derivatives. This represents a 10% deleveraging of the bank's overall portfolio, reducing the average risk exposure. The banks, by shifting the risk to investors, ensure a lower risk profile for themselves, potentially signaling improved financial health. The intricacies of this financial maneuver involve investors paying upfront for credit-linked notes issued by the bank. The banks, in turn, collect a small interest, seemingly insignificant compared to the potential default risk. In the event of a default, the bank stands to lose the entire amount leveraged as loans. However, by aggregating these loans into a pooled structure, the bank mitigates the impact of individual defaults. While the bank may incur a monthly expense in the form of interest payments, it pales in comparison to the potential losses from a significant loan default. In essence, the banks employ synthetic risk transfers to navigate the complex interplay between regulatory requirements, risk management, and financial innovation. As they minimize their exposure, the investors, particularly hedge funds, become integral players in this intricate financial dance, balancing potential returns with the inherent risks associated with these novel financial instruments. Friends, that's all we have for you today. What is your opinion about today's video? Get involved and let us know in the comments down below. Thanks for watching.